Only few major banks control almost 80% of all Forex markets. Did you know that? Bank traders are mostly long-term traders because fundamental analysis and economics reports can influence the market in days or even weeks afterwards. Banks manage client and bank positions in the open market. Have you ever entered a position thinking that the market will reverse for an uptrend, only to find yourself stuck in a falling market? False breakouts are often created as a result of a significant push by major banks to create their own markets. Unfortunately, most retail traders follow reactive strategies in retaliation to market movements. Banks could induce short-term manipulation by creating false pushes in directions opposite to what the trend is. If we observe carefully, we will be able to find the positions they accumulate over time and not fall into the trap of false buying and selling pressures. This is essentially what supply and demand traders work on. The advantages of bank position trading include limited maintenance of positions, capitalizing on more substantial trends, and dampening the noise of the market overall. Do not forget to subscribe. Please take a minute and look at a whiteboard for a moment. Let's learn some more stuff.
Smart money is the term to define the largest market participants. Smart money surely has a strong position and influence in the market. Banks are considered to be one of the major participants in market making. Although they hold a speculative position, their primary responsibility lies in the market making. I use this term to define the largest market participants, those who move massive volumes so large that their position cannot be opened and closed in a single order without spiking the market. This includes the largest banks, prop firms, massive global companies, insurance companies, hedge funds, as well as speculative traders in every variety from around the globe. It is important to understand that although the banks might control the majority of the daily volume, refer to the chart above, the vast majority of that volume is those banks acting as a market maker for other types of traders mentioned above. The Forex bank trading strategy is designed to identify where the largest market participants are likely to enter or exit their position based on areas of supply and demand. We term these levels as manipulation points. Bank traders use different strategies from swing till trend trading strategies, but most common strategy is based on fundamental analysis, price accumulation, manipulation, and distribution. Most bank traders try to enter into trade after false breakout, manipulation stage. Who trades Forex? Forex is a market that features not only a lot of players, but also a variety of players. Banks. The interbank market holds the first position in terms of the highest currency volume being traded. This is an avenue that comprises all sizes of banks coming together to trade currency among themselves and using electronic networks. When it comes to the total of the big percentage of currency volume in exchange trade, e-bank banks are the largest. Banks enable Forex trade for its clients and also handle speculative trades on bank trading desks alongside their usual banking business. When banks play the role of dealers for customers, that represents the profits of the bank. These currency trade speculations conducted by banks are a strategy to take advantage of currency fluctuations for the sake of profit. Central banks. Central banks and government-owned play a significant role in the foreign exchange market. The policies that central banks make on operations as well as interest rates on open market have a big influence on currency rates. Also, central banks take charge of fixing the rates or price of the currency on its nation on Forex. When the central bank takes any action in the FX market, it is for stabilizing or raising the level of competitiveness of the economy of its nation. Central banks, like speculators, may carry out certain currency interventions to have its currency appreciate or to have it depreciate. For instance, the central bank of any country can decide to render its currency weak with the creation of additional supplies in the course of the lengthy deflationary trends for foreign currency to be purchased with it. When this happens, its domestic currency is weakened effectively, leading to more competitive exports in the international market. It is with these strategies that central banks calm inflation. Such action also plays the role of long-term indicators for those trading in Forex. Investment managers and hedge funds. When it comes to the biggest Forex market player collection, banks, central banks, portfolio managers, hedge funds, and pooled funds come second in position. Investment managers conduct trade currency transactions for significantly large accounts like pension funds, endowments, and foundations. Investment managers that have a global portfolio do buy and conduct currency sales as a way of trading foreign securities. These investment managers can as well conduct speculative FX trades. Meanwhile, certain hedge funds that can conduct speculative currency trades have their strategy of investment. These are inflation calming strategies that central banks use. This also represents Forex traders with long-term indicators. Corporations. Firms that import and export businesses also engage in Forex trade to execute payment for their goods and services. Let's take, for example, an American solar panel firm and then sells finished products to Japan. At the end of the sell, the Japanese yen received by the firm has been converted again to US dollars. The American firm must also exchange US dollars to euros to buy more German components. The reason companies engage in Forex trade is to evade the risk that comes with the translation of foreign currencies. The same American firm might as well purchase euros from the spot market or engage in a currency swap agreement to receive dollars before buying components from this German company, which helps lessen the exposure to foreign currency risks. Retail investors make very low volume of foreign currency trades when compared with financial institutions or firms. Retail investors focus on the following fundamentals: inflation rates, monetary policy, and parity in interest rates expectations. They also consider chemical factors such as support, technical indicators, resistance, and price patterns. In the end, we see one example of how banks trade few months bearish trend. Let us look at 3 phases of trading. Phase 1 is accumulation. In this image, we can see Euro/USD and bad economic news. Please read all bad fundamental news facts on this image. Phase 2 is manipulation. In May, we see market bullish push. No economical impact on price to go bullish. Bank traders sell after short-term bullish trend. Phase 3 is distribution. On the chart, we see a bearish trend.
We will stop this. Thank you, Brian, for this excellent explanation. Just want to add some things. How banks trade. This is the very common question in trading industry. You know, my name is Igor. I'm from FX Igor channel, and I just want to add here, just to look this chart. You see accumulation, manipulation, and trend distribution period in trading. So I just want to point just 2 things when you talk about trading and banks trading. The most common ways of trading are this: accumulation, manipulation, distribution, and currency baskets. The first one, like you saw a few minutes ago, you need to find and to analyze a lot of fundamental data. You need to understand all that things which correlated with economic news, economical data, and to see very good or very bad shape of some economy. Then your goal is to match bad shape in economy and bad shape on the chart. This is the catch. But what banks do is they see very bad economic shape, for example, on this euro-dollar example. Then they wait to see some kind of retracement, some kind of, for example, like in this example, some bullish trend that's just a few days or 1 or 2 weeks trend. They know that euro is in bad shape. They want to sell euro-dollar. They just wait and try to sell, but on the rise, on that important Fibonacci level, some important price level, and then they wait in several weeks or several months, keep that sell trade and make profit. So this is the basic strategy. The another one, I didn't talk a lot in this video, but just tell you, because in the future video I will talk about that, as currency baskets. And what they do, the same thing, they use fair market value and market value. Market value is the price on the chart. Fair market value is correlated with economic shape. And then what they want to do, they want to find a moment, like in this example, when, for example, in bad economic shape, you have a strong bullish trend, or in very good economic shape, you have, for example, strong drop, and then when they find overrated, overvaluated, or underperform currency pair, they trade. They try to buy undervaluated and to sell overvaluated currency pair, and then try to create profit. But you need to understand, this is the long time positions very often. For example, banks can make position in 1st April, and they can keep that position several months. But very important thing for people who work in as a traders in big banks, they know that every single month, or every 2 weeks, or every 4 weeks, or every 6 weeks, they need to do rebalancing. So they change stop loss targets, sometimes remove some currency pair from the basket, sometimes add some currency pair in the basket, and this is the basic strategy. That strategy can use the retail traders too, and profit can be very interesting, but you need to have stronger volatility, strong trend, and then you can create a bigger profit. Latest years, these strategies are not so perfect. In my prop company, we made a lot of analysis, and we figured out that last several years for currency market, this strategy wasn't so good. But when we compare last 50 years, this strategy is very good. In stocks market, this kind of strategies were excellent last several years, because especially US markets, it was incredible years. Really strong bullish trend in the last 8 years. Perfect. Anyway, I just want to tell you and to make this notice very short, my explanation about this, and just to watch this chart and to remember about accumulation, manipulation, the distribution. And sometimes when you see fake bullish trend and fake bearish trend, just to think about that. Sometimes when you see that market is in bullish trend, It can be just the moment of manipulation and opposite. So just think about that, and always try, even you trade couple days or so on, just a little bit to monitor fundamental analysis and economy shape, because this has influence. This is it. Thank you a lot.
Do not forget to subscribe.